Okay, happy Monday and good afternoon and welcome back to our Monday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Let's go ahead and get started. We have quite a bit here to cover. I hope everyone is doing well. Now, before I get started, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, what we're trying to do is give everyone a market update as far as what's currently going on with the broader markets from a macro perspective, from an economic perspective, and what type of trends we're starting to see emerge from both US, Canadian, and commodity markets that may be relevant for your trading. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I have spent the last 14 years as a market strategist, helping clients from both retail and institutional customers better understand what's currently going on with the markets. And I leverage technical analysis very heavily in my research and my analysis because technical analysis allows me to look at all different types of asset classes, US, Canadian, interest rates, commodities, currencies, which are all relevant to your trading. So today what we're going to do is we're going to run through a few charts, show you what we're currently seeing in terms of trends from a macro perspective, what we're currently looking at from an economic perspective, and then some of the trade ideas that we would want to share with you and show you, more importantly, how I would leverage the trade ideas, specifically utilizing options to trade those ideas. So let's go ahead and get started. As we always do, we start off our Monday morning sessions talking about the TSX 60 ETF. So the XIU ETF, over the past few weeks, we've talked about how it's managed to break back above a pretty, I would say, major support level here around 24. As you can see, the $24 level provided a long-term support back in June of 2019, later in 2019, broke below that level during the coronavirus sell-off, came back to retest it, bounced off, and finally managed to break back above that $24 level. So very significant level. After breaking out, it did come back to retest this, and it now looks like it's ready to potentially start continuing higher. There are some concerns here on this recent move high because what you have here is a higher high in price, but momentum did not confirm that higher high. You actually had a lower high here on the momentum side, but daily and weekly money flow remaining still positive here at this point. So what we believe here is more likely is you might see a bit of a pullback before it can continue to move higher here. So those are what we're currently seeing here on the Canadian markets. If we look at the financials, this is the TSX Cap Financials ETF. We talked about this as a potential break above, again, a major resistance level here around 32, 32 and a half. As you can see, 32 and a half provided a fair amount of resistance for quite some time after the initial rally. Came back to retest this, found a bit of support here, and managed to break back above. But weakness here is still continuing. We're seeing weakness. Money flow on the weekly chart remains weak. Daily chart is barely positive, and momentum is starting to shift a bit to the downside here, and it is starting to retest that 32 and a half level here. So very important level to keep an eye out for. 32, as you can see, also a major level going back to the beginning of the December 2018 lows. So we're revisiting the December 2018 lows. The question is whether it can hang on to this level or not and continue to move higher, or it's more likely to fail and start moving lower. So as far as to give us an indication here, we do want to take a look at interest rates, and that is one of the key areas that we want to pay attention to. The Canadian interest rates is actually looking substantially stronger than US interest rates, and that may be what bifurcates Canadian banks from US banks. You might see that interest revenue from Canadian banks may be a little higher than their American counterparts. So that is one major thing that we're paying attention to, because trading revenue and M&A, trading revenue a little higher during coronavirus as volatility picks up, but M&A activity really falling off of a cliff, and we expect that towards the end of this year, M&A activity and investment banking fees is definitely going to be on the softer side for banks going into Q3, Q4. So interest margin and interest revenue is really what banks predominantly make most of their money on, and what we want to look at is really interest rates, because that is very heavily tied towards the value of Canadian interest rates. I did want to update everyone here on the S&P 500, the US markets. I know many of you trade this market, and it is relevant to Canadian performance as well. So one of the things that we did point out here is that 323 on the SPY is a major resistance level that we currently see. And we see the same issue here on the S&P 500, where over the last week, as it started to make a higher high, momentum did not confirm that higher high and made a lower high. That type of negative divergence is not particularly strong on a breakout. You don't want to see that type of negative divergence on a breakout. That points that breakout is potentially a false breakout. And that's exactly what we saw at the end of last week. After initially breaking out, almost looking like it was going to attempt to move higher and then reverse lower. And today, it has not managed to get back above that 323 level, which is significant. The one thing is that the money flow weekly and daily still remains positive, which is strong. However, that negative divergence is a concern, and what is more likely going to happen is S&P is more likely to trade within a bit of a range here until it can manage to break back above and momentum confirms that move higher. So there are some concerns here in the US markets in terms of whether or not it has enough strength to continue to rally. There are still plenty of, I would say, bullish indicators here in the US markets, but the current price action suggests that we may take a bit of a pause and we might see some consolidation here over the next few trading days and potentially even the next few trading weeks. One trend that I did want to point out and reiterate again that we spoke about here last week that has continued is the dollar weakness, and that is going to largely affect the dollar CAD exchange rate, which many of you either trade, some of you heavily watch this because of your own investments, and you need to pay attention here to dollar CAD. So one of the things that we wanted to point out here last week when we spoke, it was when the dollar CAD was still trading above the 200-day moving average, but it's recently broken below the 200-day moving average. It is now testing the 133 support level. Now that is a pretty significant support level because breaks below that will bring you back into the 130s. Dollar CAD traded between 130 for a long time, 130 and 133 for almost a year and a half. So you have a lot of congestion here in this particular zone. So breaking back into the 130, 133, you might see some congestion here in this zone, but a break below 133 brings us all the way down into the low 120s. So this is potentially on the verge of a much bigger breakout here on dollar CAD to the downside. And further, this is supported by the interest rate differential. So if you look at the gray line, which is the interest rate differential, you've seen a significant increase in terms of how strong Canadian interest rates are versus US interest rates. And what you generally see is a very high correlation between exchange rates and interest rate differentials. So this is pointing towards a significantly weaker dollar CAD going forward based on interest rate differentials, which is by far usually the single largest driver of currency exchange rates more than any other factor. With the dollar CAD, the two largest factors are really oil prices and interest rate differentials. So those are the two that we're paying attention to, but interest rate differentials currently pointing to a significantly weaker dollar CAD. Now, we do have some other charts to share with you here, which predominantly is going to be on the crude oil side. So crude, despite dollar getting much weaker, which many times if we think about our commodities, most global economies are priced in the USD. So as USD gets weaker, what we generally tend to find is that commodities gets more expensive because it's priced in USD. We have not quite seen this here in crude. So we haven't seen the move higher in crude. And this is something that we've been talking about for quite some weeks because crude continues to grind higher into this very, very tight apex. Momentum continues to weaken. Money flow has gotten a little bit weaker, but remains positive on both the weekly and daily. And it's still below this major $41 level. So it's important for us to pay attention to the fact that crude has not managed to break back above that level and may likely fail and start moving lower here. We don't quite have an indication as to where oil is going to go even from a fundamental perspective. So this is another one that we're just going to continue updating you week to week as we see any type of breakouts. Oil tried to break out to the upside here last week, but that rally did not sustain itself and is looking like that may fail. So crude, not much to tell, but gold and silver was really the headline last week. After making some substantial gains here in gold today managed to break back above its absolute all-time high from September 2011. So for those of you that trade mining stocks, and we have some of those to look at here today, mining stocks taking off in conjunction with the gold and silver moves. So gold really looking like it's going to see some further strength here, breaking above that all-time high. Chances are, I think that you're going to see a continuation higher. You might get a bit of consolidation here in the short run to bleed off some of that momentum. As you can see, momentum severely overbought here, but money flow very strong both on the daily and the weekly chart. But likely you might get a bit of a bleed off here in the momentum and then continue to move higher. So I do think that this does pave the way, especially with the weaker dollar, for gold to be substantially higher and break above this all-time high. So with that, I wanted to take a look at some of the ideas that we have here to share with you this week. First, I wanted to look at Canadian Pacific Railway. Last week, we talked about Canadian National Railway. Now we're looking at Canadian Pacific, very similar setup, where the stock recently broke above a double top. I would say arguably even a triple top, managed to break back above that let's just call it a 270 level or so, 270, 272, 273 level. As you can see, the stock reacted to this level multiple times, managed to break out, and looks like it's now possibly looking for a continuation higher. Similar to the other charts, a little bit of negative divergence here. So you have a higher high without a confirmation from the momentum indicator. That leads us to generally believe that you usually will get a bit of a pullback here before you can continue moving higher. But constructively, this chart looks strong. Not only is this a stronger sector, the chart itself is one of the few stocks that in the Canadian markets that has managed to make it back to its all-time high, break above it, consolidate above that level for about a week or so, and looks like it's constructive for a continuation higher here. And I know that someone pointed out, good point, I accidentally have the the US version of that chart. What I really meant to show you is the Canadian version of that chart, which if we just update you on those levels is not the 270 level, it is the 365 level here is the level that I'm referring to here on the Canadian markets. So breaking above that 365 level, consolidating it for a past week, and looks like it might continue to move higher here. So Canadian Pacific, certainly one of the stocks that we have on our watch list here for Canadian markets. So thank you so much, Maurice, for pointing that out. The next one I wanted to take a look at is Kirkland Gold. This is along the lines of any of the mining stocks. And there are a handful of stocks in this particular sector or segment of the market. And many of you may be either trading them, maybe you have positions in them, maybe you're trying to establish a position in them. So I just want to take a look at these names from an options perspective and talk a little bit about how can you position yourself for continuation higher on gold moving higher. If you don't already have a position, how do you continue to play for upside, but do so in a way where you can protect yourself if, let's say, gold comes crashing back down? And that is a real concern, because when you're playing these gold miners, they're more of playing these gold miners is almost like using a leverage position on gold, meaning when gold makes a move, the miners will typically make a bigger move compared to the underlying stock, the underlying commodity itself. So one of the things I wanted to point out here is Kirkland Gold. Just looking, it's about to break out from that $65, $67 high here, and you've got that breakout here. So how do you play for a breakout here in this particular instance with a fairly limited amount of risk? And that really comes down to utilizing options. So one of the things that we want to take a look at is how can we use options to play for a continuation higher here? Let's see. Kirkland Gold trading at 67. So in this type of environment, you generally tend to find that the best strategies are utilizing call options. Call options many times will give you the best strategy here to take a bullish view here going into an earnings event like a Kirkland Gold, which reports earnings here in 3 days. As you can see here, I can buy a September $68 call, a call that's slightly out of the money. This is really one of the only times, in my opinion, where it makes sense to buy an out of the money call option is when you're going into a risky event such as earnings and you're playing for a breakout to all-time highs, but you don't really have a good guarantee of that happening and you want to do so with a limited amount of risk. Now, this isn't necessarily a small amount of risk here, $540. $540 on a $67 stock is still risking roughly 8% of the underlying stock price. But 8% in a gold miner, in my opinion, is on the smaller end of things because gold miners usually are far more volatile than most other stocks in the market. So risking 8% is the way that I would play this for a breakout here. If you get a quick breakout, usually you can get maybe anywhere from a 50 to 75% gain relatively quickly on that call option and you can take profits. If the trade goes against you, the most you're risking is just 8% of the underlying stock price. That's really the best way to play for these types of breakouts rather than outright buying the stock or many other strategies. And, you know, spreads, many times people will ask, you know, will spreads work? One of the concerns here is that, you know, on September, the highest strike that's listed is 68. So you can't really spread this. You can trade small, you can trade diagonals or calendars. You can certainly do that. That's one other option. But a simple option is just simply buying a call option here, playing for that breakout. If you don't get that breakout, you just simply cut your losses, close out the call option at whatever place. But if you do get that breakout, usually you can get a leverage play on that move. But more importantly, the most you're risking here is just 8% of the underlying stock price. And lastly, we've been getting a lot of questions, and we continue to get questions about marijuana companies, Aurora, Canopy, all of them. And, you know, I continue to go back to the chart, and I show you the weekly chart, right? You had this brief uptick, if you will, on that earnings event that looked like it was positive, and you've gotten nothing except for a drift lower since that. So from my perspective, there is nothing attractive about this particular industry. There's nothing on the horizon at the moment that points to a turnaround in this particular industry just yet. So I continue to prefer selling call credit spreads on this type of industry and look for, especially when you get a move higher here, any type of rally, those are opportunities to sell call credit spreads. So I'll show you some here, like I'll take a look at Aurora Cannabis, and we could pull this up for any of the cannabis companies. Now, I wouldn't call the recent streak a rally, so I don't think the timing on this particular trade is particularly good. I would wait for a bit of a rally here for these types of trades, but the type of trade that I would be looking at is something like a call vertical, shorting a call vertical, where when the stock's trading at 13.94, I might sell the 14.16 call spread here, collect 65 cents on a $2 wide credit spread, risking 135 while potentially making 65. That's really the strategy that I would take here for these types of names that are making these slow grinds lower. There's really no better way to play these slow grinds lower than when they rally, selling these types of call credit spreads. Now, you know, Aurora Cannabis, you know, does have weekly options, but there aren't many. So you don't have a lot of choice between August and September. So you have to go all the way out to September, which usually is a little longer than I would like to, but you don't really have a lot of options here. And just take a look at Canopy here. Now, Canopy has seemed to manage to stem the decline, and it's really just moving sideways here. But I think the strategy still exists, but just now within a trading range. As you get near the top of the range, you sell call credit spreads. As you get to the bottom of the range, you sell put credit spreads. But so when it's trading here in the upper end of the range, I would look at selling perhaps a call credit spread. Now also Canopy, same thing, only has weekly options out to the August 14th. So you have to go out to September. You know, when the stock's trading at 22.63, I would look at selling a 23.26. Collecting roughly 95 cents out of a $3 wide credit spread. A little less than what I'd want. Here, I'd probably put a limit order here for maybe $1 as opposed to 95 cents, because you always want to collect about a third of the width on a credit spread like this. Even though it's out of the money a bit by about 40 cents here or so, which is a decent percentage of the underlying stock price, you still generally want to try to collect about 1/3 of the width whenever you're selling a credit spread like that. So that covers from my perspective, what I wanted to share with you here today in terms of what my views are on the macro market from an equities perspective, both US and Canada, how we're currently looking at the commodity markets with gold, and those provide some opportunities with gold and the gold mining stocks. But really the big theme that I see for Canadian investors this particular week is the breakdown here in USD. This is bringing strength to the Canadian dollar. Many of you have positions either in the US or Canada that you might want to consider in terms of whether you're trading the dollar CAD, or if you have positions that you might want to move around, or perhaps some themes or some trades that you want to put on as a result of this weakening of the USD. That's the big theme that I think will start playing, will play a bigger role here in US and Canada investment decisions for a lot of you that are currently invested in cross-border positions. So with that, thank you so much for taking the time out here this morning. For those of you that do not have access to OptionsPlay yet, you can register for free using the link that's here on my screen, which I will post into the chat window. This is designed to help you better understand how to look at option strategies so that you can take a look at these strategies side by side and give you a starting point on your options trading using the trade and income tab, really designed to give you a brand new user experience of how to look at and explore options, and at the same time providing you with education, content, and reports to help you actually execute the things that you're going to learn as far as how to trade options. So a lot of tools and a lot of wealth of information available to all Canadian investors completely free of charge, courtesy of the Montreal Exchange. So please, if you don't already have access to it, sign up using that link. And if you've already signed up for a free trial, please log in and take a look. We constantly are putting out new reports and content for you guys to better understand how to utilize and leverage options for your portfolio. So make sure that you log in from time to time, analyze using the tools so that whenever you're trading options, you have the tools that allow you to better understand your strategies before you start trading any option strategies. So with that, what I'll do is I'll open this up. I have a few minutes here for Q&A. And I'll try to answer some questions for any of you that have questions regarding anything that I spoke about here today. So Parminder asked, as an investor, should I follow euphoric or future turnarounds? Which will be the best to pick? I'm not sure what you mean by euphoric or future turnarounds. If you don't mind clarifying, I'm happy to try to answer your question. Bob is saying a strong Canadian dollar increases costs for Canadian manufacturers. A lot of that sector has struggled its way upward in recent weeks. Any thoughts? So absolutely, Bob. I will say that, the strength in the Canadian dollar hasn't been much yet. I'm just saying that we have a start to a strength in Canadian dollar. I don't think we've seen any real reports of manufacturers saying that the strength of the Canadian dollar has affected their bottom line just yet. But as long as they continue to weaken, as long as the Canadian dollar continues to strengthen below this 133 level, then I do think that you're going to start seeing some of those concerns. But I don't know that we have seen those yet pop up in earnings reports just yet. I think most of the earnings reports so far have had minimal impact of FX at the moment. But again, this is one of the themes that we want to point out before you start to see that. But I think you're absolutely right. Should I let options liquidity influence which stocks I invest in? Options liquidity is not something you should be concerned about if you're investing in the stock itself. If you're trading options on that stock, absolutely. If it's something that's not very liquid, I would argue that I don't think you should trade it, because if it's not very liquid, you're going to have a hard time getting in, you're going to have a hard time getting out, and you're going to have to pay to get in and get out, and you're going to have to pay heavily. So I generally will never trade something that's not very liquid. It's just not worth it. There's plenty of other things that are liquid that I want to trade, but if you're investing in the stock itself, options liquidity doesn't have much influence. Swami is asking, can you please comment on MSI Motorola? By seeing the charts, is it a good time to buy options? Is MSI a Canadian listed option? It is not. So I'm only looking at Canadian based symbols here, Swami. Do you use Fibonacci for technical analysis? I do not. The reason I don't use Fibonacci is because Fibonacci is too subjective. Anyone can draw their Fibonacci lines from anywhere to anywhere. There's no real hard and fast rule as far as how you draw your Fibonacci line. So if I draw it this way from wick to wick, I'll get different Fibonacci lines than if I use the top of the body of the candle. So there's just too much subjectivity. Where do you start? You know, do you start down here? Do you start over here? You know, there's no rules, and it's nothing other than you creating your own lines and drawing self-fulfilling prophecies. That's why I'm not a big fan of using Fibonacci. Parminder, I have it, but do not understand. Can you give me your email or in your group to understand? Sure, Parminder, you can send us an email at info@optionsplay.com. I just sent you the link in the chat window. Looks like I have a Q&A from up here. Let's see. I currently hold call options on gold and silver, which are up over 200%. Continue to hold. I worry that they have become too large of a part of my portfolio. John, great question. So many of you may find yourself in a similar position where you have a call option on gold or silver. It's up a lot of money and you're thinking to yourself, what do I do? How do I protect my portfolio? The best thing to do, in my opinion, is to roll those positions up. So let's say you have, I'm just going to use gold futures, for example. Let's say you had an 1800 call option, and now the stock's trading, and the gold is now trading at 1933. What you want to do is you want to sell your 1800 call option and roll it up to maybe a 1900 call option. And by doing that, when you roll it up, you're going to trade that at a credit, which means that you're going to take some risk off the table. You're going to take some profits while still maintaining further upside. So if you find yourself where you're up over 100% on a call option, start rolling those calls higher. At 200% gain, you basically can take all of your risk off the table and more and still maintain effectively what is a free bullish position in gold and silver. So I highly recommend, if you're up 200%, think about rolling those positions. At what point is a stock overbought? So, we usually use momentum indicators. So RSI above 70 is considered overbought, but keep in mind that when something's overbought, it doesn't mean that it can't continue to be overbought. So as you can see here, gold became overbought here on July 21st when it was trading at 1840, but that doesn't stop it from being more overbought for long. So that's the one thing about overbought or oversold, is that all it's telling you is that statistically, it's getting to a point where it's likely going to reverse, but just because it's likely going to reverse doesn't mean that it's going to reverse. So those are two different things, but we usually use momentum to measure whether something's overbought or oversold. Can you comment on KXS? Is that a Canadian symbol? Yes, it is. Let's take a look at this. Kinex, I don't know much about this particular stock, but the one thing that I will say is that, as you can see here, over the past month or two, as it continued to move higher, momentum actually did not confirm those moves higher. That's usually the hallmarks of a stock that's getting exhausted, that's reaching a bit of a top and has a higher probability of a move lower here. You have a lot of congestion here in the 180, 165, 160, 180 range. So I think you probably have at least a chance of this revisiting 180, potentially even into the 170 area. And then potentially moving higher if this is a stock that you like fundamentally. I just don't know anything about the fundamentals of the stock, but just looking at the chart itself, higher probability of pullback because you have that negative divergence and momentum is now starting to turn negative. So with that, that covers what I wanted to share with you here today. I really hope that you guys find this useful in helping you better understand how to look at the charts, how to utilize OptionsPlay, and how to take a look at these trade ideas. And it looks like we have one last one, QQC. This is the Invesco. Oh, this is the Canadian Qs index. So similar type chart setup here, right? Recently continuation higher high, momentum did not confirm that. So this leads me to believe that technology is starting to lag behind a bit. And notice how today technology is on the stronger end here. S&P up 0.5%, Dow up 1/3, NASDAQ up almost 1% here. So certainly technology remains one of the strongest sectors here. It did manage to resolve some of that, that negative divergence. So I do think technology could potentially continue moving higher here. So with that, thank you so much. I hope that you guys find this useful in helping you set up your trading day and your trading week. I'll be back here next Monday for our morning session again. So please send us an email if you have any questions regarding anything at info@optionsplay.com, and we'll send you the recording of everything here when we finish. Have a great day.